Morning, Rhonda, we'll send it back to you.
All right, Ashley, thanks so much. And we're back with Jay Brown, Chief Executive of the NBIA, who is with us for the full hour. And joining us as well now is Bloomberg's Margaret Popper. Margaret?
Thanks, Rhonda. Jay, wanted to ask you about the genesis of this whole restructuring and what happened with the rating agencies and how you came to this place. Wanted to know if your view of what the rating agencies have done is to kind of box you into a corner, because after all, when you look at the amount of money that you've got to pay off claims, you're more than well funded for that. So what do you think the rating agencies were trying to achieve on the capital side, and did they do the right thing?
I think the rating agencies got caught in the the big economic issue, which is U.S. real estate. We had an incredible change in the performance of virtually all mortgage securities in the space of 3 or 4 months. And so their models failed to predict that. Our models, in the cases where we have direct exposure to real estate, underestimated the severity of that change and how quickly it could occur. And when I look at it, I say they didn't get that one right. They're not perfect. They're not perfect forecasters. Either are we. Their response to the industry, which really has come in 2 big phases. The first response, which we heard about in November and December, when they were upping their models, revising their estimates, was classic for the rating agencies. When you have a problem, they look at their models, they adjust, and throw out a new forecast. We responded to that with a plan, in our case at MBA, that was going to take 2 months to raise these sufficient cash capital. They came back again in January and February with revised estimates based on more data. And this time I think they tried very aggressively to say, we only want to do this twice for U.S. real estate and related credit exposures. So they tried to move those numbers out to where they think the ultimate estimated stress case might be if we go into literally a really total breakdown in the U.S. housing market. So that's where they put the goalpost. That caused us to have to do more than just raise capital. It caused us to have to respond and adjust our business model a little bit more than we might have otherwise if they hadn't moved it. But I think their response, and at least for the responsible agencies, has been very, very thoughtful under incredible duress.
How often are you in communications with them now that you have your AAA rating? You said you felt confident you'd have that for about a year or so, but yeah. What types of communications are you having now? Well,
it's very typical for us in the ordinary course of business, and this is not the ordinary course of business, to have on the overall company have meetings, 3, 4, 5, 6, 8 times a year. This is unusual times.
Right.
And, I can tell you, in my time in this business, I never went to see a rating agency on a Sunday or another rating agency on another Sunday. So we've had a lot of frequent contact, but going forward, I think it'll slow down to more normal.
All right, we got to take another break here and get back to normal with our programming. That means a check of world and national news coming up.